Now that we have learned which price ratios to use and when, we are going to discuss how to turn them into yields and why you should do so. All of the best investors, such as Benjamin Graham, who is the author of The Intelligent Investor, thought about stocks in terms of the yields they offer to their investors. And in this video, I'm going to show you exactly how you can convert any stock into its yield. So to start off, we already learned that the price to earnings ratio is simply the price of the business divided by its earnings. Now, to find the earnings yield, what you need to do is divide the earnings by the price, then multiply it by 100% to turn it into a percentage. What this means is the price to earnings ratio and the earnings yield are inverse to each other. So what you can do to skip all of these steps is simply to divide 1 by whatever the price ratio is that you are using. Whether that is the price to free cash flow, price to earnings ratio, or the price to operating cash flow ratio. Let me show you. If a stock has a valuation of $1 billion and produces $50 million in annual earnings, then it has a 20 price to earnings ratio. Now let's think about how much this business could return to you from its earnings in terms of a percentage. $1 billion again is the price we paid for the stock, and it is producing that $50 million in annual earnings. Then this is a 5% yield for its shareholders, and the math goes like this. $50 million in earnings divided by the $1 billion price, multiply that by 100% equals 5%. So 5% is the yield investors are getting when they buy the stock at that 20 price to earnings ratio. Now, the fast way to do this calculation is simply to divide 1 by the price to earnings ratio, and I promise that this works every single time. So check this out. 1 divided by 20 multiplied by 100% equals 5%, just like that, which is the exact same thing as typing in all of the actual values of the price of the business and its annual earnings. To put it simply, the yield on the stock is the inverse of the price ratio, which means you can divide 1 by the price ratio to find the stock's yield. Again, this always works, and the math checks out. So once you find out which price ratio it is that you want to be using on the stock you're looking at, then you can easily convert the price ratio into the yield the stock is offering, again, simply by dividing 1 by the price ratio. Also, Stock Unlock does this for you, and we convert all of the price ratios into yields so you do not have to. So then the next question to answer is, why should investors convert price ratios into yields? And what is the point of doing this? And there are 2 answers to this question. 1, because thinking in terms of yields allows you to easily understand how much the business can return back to you as the shareholder. And 2, because by converting stock price ratios into yields, you can start to compare yields on the stock versus any other investment, which is incredibly important. This is what Warren Buffett does, by the way. He always says that investors should be comparing the yield on stocks versus the yield on bonds, because bonds are essentially the risk-free rate. And investors should be comparing the 10-year bond yield versus their stock yields to find out which one is yielding more. And if bond yields are yielding more than a stock yield, then he says that that stock has no margin of safety. And this is actually written in The Intelligent Investor as well. So to put it simply, if a stock has a higher yield than a bond, then it has a margin of safety. If a stock does not have a higher yield than a 10-year government bond, then it is selling for no margin of safety. And I actually went through The Intelligent Investor and I found the specific pages that explain what a margin of safety is. And again, you have got to find the yield of your stock to know if it has a margin of safety when you're buying it or not. So this is from page 514 of The Intelligent Investor, right near the end of the book. And that says, in the ordinary common stock bought for investment under normal conditions, the margin of safety lies in an expected earning power considerably above the going rate for bonds. In the former editions, we elucidated to this point with the following figures. Assume in the typical case that the earnings power is 9% on the price and that the bond rate is 4%. Then the stock buyer will have an average annual margin of 5% accruing in their favor. So quite literally and quite clearly, the Intelligent Investor right here is saying that the earnings yield on a stock versus the earnings yield on a bond, or the yield on a bond, is your margin of safety. And the example that they use here is that the earnings yield on a stock is 9% and bonds have 4%, which means that the stock has a margin of safety of 5% for the investor. The margin of safety on an investment is the percent difference of the yield on the stock versus the yield on a 10-year government bond. Whatever that difference is your margin of safety. So again, if your stock has a yield below a government bond, then it means that the stock has no margin of safety according to the intelligent investor. Now, if we go on to the next screenshot right here, it clearly explains this in a little bit more depth. This is on page 515 of the Intelligent Investor, and this says, over a 10-year period, the typical excess of stock earning power over bond interest may aggregate 50% of the price paid. This figure is sufficient to provide a very real margin of safety, which, under favorable conditions, will prevent or minimize a loss. If such a margin is present in each of a diversified list of 20 or more stocks, the probability of a favorable result under fairly normal conditions becomes very large. That is why the policy of investing in representative common stocks does not require high qualities of insight and foresight to work out successfully. If the purchases are made at the average level of the market over a span of years, the prices paid should carry with them assurances of adequate margin of safety. The danger to investors lies in concentrating their purchases in the upper levels of the market or in buying non-representative common stocks that carry more than average risk of diminished earnings power. So basically what this paragraph right here from the Intelligent Investor is saying is that if you own a high quality stock, then its earnings power should grow by 50% over the next decade on average. And if the earnings of a business grows over the next decade by 50%, then your earnings yield on cost will grow with that investment. And since your earnings yield on cost is growing, so does your margin of safety. So basically what Benjamin Graham is saying right here is that if you buy a stock that has an earnings yield above a bond yield, and then that stock can go on to grow its earnings, then your yield grows even further above a bond yield, which grows your margin of safety. This is also why moats are so important to consider when you are investing, because you have to be investing in stocks that are going to grow, or at least you should be investing in stocks that are going to grow reliably over the next decade. So if we're investing in stocks that do not have a moat and we really don't know if they're going to be profitable or be growing or even be around over the next 5, 10, 20 years, then that adds a large amount of risk to our investment. Because if those stocks lose sales to competitors over the next 5 years, then that means our earnings yield on cost will actually go down over time instead of going up. That is also why Warren Buffett says that investors should seriously consider the moat of their investments. They should meditate and try to find out and figure out if the stocks that they're buying do have long-term moats that will allow them to continue growing over the long term. Because again, if they can continue growing over the long term, then your earnings yield on cost will go up over time and act as an additional layer of a margin of safety. Now also the bottom of this page 515 says, the margin of safety is the difference between the percentage rate of the earnings on the stock at the price you pay for it and the rate of interest on bonds. And that margin of safety is the difference by which would absorb unsatisfactory developments. At the time the 1965 edition of The Intelligent Investor was written, the typical stock was selling for 11 times earnings, giving about a 9% return against 4% on bonds. In that case, you had a margin of safety of well over 100%. Basically, what Benjamin Graham is saying here again is simply that the difference between the earnings yield on a stock and whatever the interest rate is on a bond is your margin of safety. Back in 1965, he is saying that the typical stock was selling for 11 times earnings, which when you inverse that is a 9% earnings yield. At the same time, bonds were yielding 4%. So basically what he's saying is that a 9% earnings yield on a stock versus a 4% yield on a bond means that you're getting more than double the yield on a stock, or that your margin of safety is over 100%. Because again, you're getting more than a double yield on whatever a bond is offering. Now, we can also head over to Stock Unlock and see all of this playing out in action. And we're going to check out Google to explain this even more. So for Google, I prefer to use the free cash flow yield because in our last video, I explained why I prefer to use free cash flow metrics instead of earnings metrics on a lot of stocks, and Google is one of them. So we're going to take a look at Google's free cash flow yield over the past decade. And we can see here that right now, Google has a free cash flow yield of just over 5%. Now back here in 2018, Google had a free cash flow yield of only 2.4%. So basically what we can see here is that over time, Google's free cash flow yield has changed. Now what's also interesting is if we go to Google's free cash flow yield on cost, this shows us what our free cash flow yield would be today based on when we bought Google historically. Because remember, if we're buying a stock and then the underlying business continues growing over time, then our yield on cost will increase. So for example, back here in 2012, if I was buying Google stock, then the free cash flow yield would have been 6.75% at the time of buying the stock. However, Google has grown massively over the past decade. So now all of the shares purchased in 2012 now have a free cash flow yield of nearly 33% on cost, because the price I paid for Google back in 2012 has not changed at all. But what has changed is the amount of free cash flow that Google can generate. And since Google now generates more free cash flow, I have a higher free cash flow yield on my cost, which has provided an absolutely massive margin of safety for anyone who purchased Google shares back in 2012. Now, also, if we go back to the Intelligent Investor and we go and take a look at this page right here, it says the margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, and non-existent at some still higher price. So what this is saying in the Intelligent Investor is that your margin of safety depends on the price that you're paying always, all of the time. And if you pay a higher price, then your margin of safety goes down. And if you pay a very high price, then there is no margin of safety. So let's go back over here to Stock Unlock. Let's take a look at Google's free cash flow yield versus its market cap over time. And I'm going to zoom in from about 2017 to 2020 to make this point a little bit more clear. And I'm going to zoom in from 2018 to 2020 just to explain this point a little bit more clearly. So this lighter blue line is Google's market cap, and the dotted darker line is Google's free cash flow yield. Now, right here in 2020, we all know that the stock market absolutely crashed, right? And we can see that right here in February, Google had a free cash flow yield of 3%. Then when the stock market crashed and Google's share price also crashed, the free cash flow yield went up to 4.3% if we want to round up. So we can clearly see here that as Google's market cap or share price fell, its free cash flow yield went up. And this is because Google's free cash flow didn't really change, but what changed is the price that investors were paying for that free cash flow. So the price for the free cash flow dropped, which means that Google's free cash flow yield went up. And as we also learned, investors should be comparing cash flow yields or earnings yield versus bond yields to find out if there is a margin of safety. So what this means is that when Google's share price and market cap fell right here, or the price of the business fell, its yield went up, which means its margin of safety also went up. Now, if Google's share price started increasing rapidly, then what that would mean is the free cash flow yield would decline and the margin of safety would decline. So basically, just to put this all simply, when stock prices fall, there's actually a higher margin of safety associated with buying the stock. And when stock prices run like crazy, there is a much lower margin of safety. And what we can also do here in Stock Unlock is enter in the 10-year bond yield. So back here, we can clearly see that the 10-year bond yield was about 2.96% versus Google's free cash flow yield of about 2.4%. So back in 2018, Google was not producing as much of a free cash flow yield as a 10-year government bond. And since the bond yield was producing more, then it basically means that Google did not have any margin of safety back in 2018. Then this relationship finally changed, and we can see back here that in 2020, Google's free cash flow yield was about that 4.3%, and the 10-year government bond yield was about 0.76%. So there was a massive margin of safety in buying Google stock at the pit there of the stock market crash in 2020. Now, if we zoom out to today, we can see that Google stock has a 5% free cash flow yield now, and the government bond has a 3.5% yield, which still means that Google is selling for a margin of safety today. And the margin of safety is that 1.5% difference in Google's free cash flow yield versus what government bonds are offering. Now, also what we did here on Stock Unlock is we created our own metric called the risk premium. And you can use the risk premium earnings, free cash flow, or operating cash flow, depending on whatever metric you want to use on the stock you're looking at. For Google, I like to use the free cash flow. And what the risk premium does is it shows you when the stock is selling for a margin of safety, because it takes the free cash flow yield and it divides it by whatever the bond yield is offering. So if the risk premium is above 1, then it means that the stock has a margin of safety. If the risk premium is below 1, then it means that the stock has no margin of safety. Or in other words, the higher the risk premium, the more margin of safety there is. And the lower the risk premium, the less margin of safety there is. So right here, again, we can see that Google's risk premium is sitting at 1.45. So since Google's risk premium is above 1, it means that there is a margin of safety here. However, if we go back to 2018, when Google's free cash flow yield was below bond yields, then we can see that the risk premium back then was 0.86 or 0.87 if we want to round up. So since Google's risk premium was below 1 back in 2018, it means that the stock was selling for no margin of safety. Now, what's also interesting is right here during the stock market crash, we can see that Google's risk premium absolutely skyrocketed because the market cap or the price of the business fell dramatically. And as the price of the business fell, the free cash flow yield went up, which means that the margin of safety or the risk premium went up as well. And we can see right here that in 2020, Google's risk premium went all the way up to nearly 7, meaning that Google in March of 2020 was an absolute steal. It was such a good buy right here, and it had a massive, massive margin of safety. And congrats to anyone who was buying Google in March of 2020. I sure wish I was. But what all of this is meant to show you is that you can clearly see that as the stock price rises, or as the price of the business rises, your margin of safety goes down. And as the price of the business declines, the margin of safety goes up, as we can clearly see right here with Google's risk premium spiking in March of 2020. So what our job as investors is to find the stocks with the best risk reward ratios, or they offer the best reward for taking on the lowest amount of risk. So now let's go and take a look at a stock like Nvidia, and let's take a look at its risk premium or margin of safety. Now we can see that Nvidia has a risk premium of 0.3, which means that this stock is not offering anything close to what bonds can offer right now. So what this means is that investors could be getting nearly a 3 times better return on their investment, totally risk-free, by buying a government bond, which also means that Nvidia has zero margin of safety today. This stock is incredibly risky at its current price. So that is how we can also use risk premiums in our own stocks and in our own investing to figure out if a stock has a margin of safety, if it is expensive right now, or if it is looking a little bit more cheap. Now, also just for fun, Warren Buffett has recently been buying a lot of HPQ, and he has also been buying Occidental Petroleum. These are two stocks that he has been loading up on quite a bit over the past few quarters. Now, if we take a look at these stocks' risk premiums right here, we can see that HPQ has a risk premium of 3.78, which is pretty dang high, and Occidental has a risk premium of 6. What this means is that Occidental Petroleum is yielding 6 times as much as a government bond for its investors, which means that it has an absolutely massive margin of safety. HPQ, same story. It is yielding 3.78 times as much as a bond, which means that it also has a massive margin of safety. This is why Warren Buffett is so aggressively buying these stocks, especially Occidental Petroleum. Like if we go over to Occidental Petroleum's free cash flow yield, let's just take a look. Its free cash flow yield is 20.76%. So based on the company's stock price today, it can yield over 20% for its investors just through the free cash flow that the business behind the stock is generating. Now, when you compare that to government bond yields, again, the bond yield is 3.5% today. So Occidental Petroleum is yielding significantly more returns for its investors than a bond yield, which means that it has a massive margin of safety, which is also why Warren Buffett is buying this stock like as much as he possibly can. So that's also how you can use the risk premium, the margin of safety, the yields. That's why you should convert price ratios into yields all of the time, because then you can accurately and easily compare any stock versus a bond yield or any other investment. When we're looking at price ratios, it's not very intuitive. Like if I tell you, hey, this stock is selling for a 25 price to free cash flow, what does that mean? Well, what it means is the stock can yield you 4% on your investment based on the cash flow that the business can generate for you. But I can do that in my head because I work with price ratios and yields all freaking day, right? I can just do that mentally. But for someone who does not work with yields and price ratios all the time, you don't have these numbers memorized in your head. So it's just much easier to be like, okay, 25 price to free cash flow. Let's convert that into the free cash flow yield. Do some simple math. Okay, free cash flow yield is 4%. Well, now we can compare that 4% versus a bond, and we can see if this business is generating more than a bond or less than a bond, and if it has a margin of safety. So that is really why investors should focus on using yields instead of stock prices or price ratios. But that's going to wrap up the video, everyone. I feel like this is going to be another long one. Yeah, it's going to be another pretty long video, but I really hope you guys enjoyed. I think that this is going to be a very educational video that will help you guys become better investors, which is the entire purpose of Stock Unlock. Stock Unlock is an absolutely fantastic platform, you guys. It is 100% focused on turning you into a better and more profitable investor over time. And it's just a platform for true long-term fundamental investing that is built on all of the principles of the intelligent investor, Warren Buffett, Charlie Munger, Peter Lynch, and all of these legendary investors. Zero hype in this platform. It's all about turning you into a good fundamental investor so that you can build your wealth over the long term. So if you have not checked out Stock Unlock yet, seriously, go and check it out. Get a 14-day free trial. You do not need a credit card at all. All you need is your email and you will get full access to the platform. So seriously, you guys, do yourself a favor, go and sign up for Stock Unlock, play around with all of our features, and after your 14-day free trial, I can guarantee that you will become a better investor. So go and get Stock Unlock. But seriously, thank you guys so much for watching. I truly do appreciate it. Remember to leave a like on the video if you enjoyed it. Subscribe to the channel if you're new here, and I hope to see you all again in our next video.